Good morning, everybody, and welcome. My name is Andrew Fraser. I'm the State Manager for New South Wales of HUB24, and welcome to this month's HUBsights webinar where we're featuring microcaps. Before we get things underway, I need to mention a few housekeeping items. The lines will remain muted throughout the presentation to prevent any background noise. So if you've got any questions, please use the webinar control panel to send them through to the team. We'll have a combined Q&A at the end of both presentations. So today we're joined by Michael Glennon from Glennon Capital, who'll be presenting on the characteristics of a quality microcap company, followed by Andrew Smith from Perennial, who present his thoughts on how to find investment gems in an under-researched microcap area. So without further ado, I'd like to hand over to Michael from Glennon Capital.
Thanks, Andrew. Okay, so just to give you a bit of background on Glennon Capital. So I set the business up in 2008, and we invest in small, micro and mid caps, and that's all we do. And we've had a long association with HUB24. We've been on the platform since 2011. We try to be long-term investors, so the portfolio's got quite low turnover, and we've held stocks for many years, which means you've really got to get it right when you're looking for those investments. There's some of the things that we look for. Is quality, and to define what quality is, I'll go through some of the things that we look at. So, and I'll go into detail on some of these attributes a little bit later, but the key thing for us is management, having superior management, because in small caps you don't have multi-stream businesses, so it's not like a BHP or a National Australia Bank that's got many businesses inside of it. They're quite binary. Sometimes you might just have one product or one division. If something goes wrong, the business can go broke. So making sure you've got good management there is crucial when there's such high risk businesses. The other thing we like to make sure that we've got is growth. So whether that be a market that's growing or a company that's growing its market share within an industry, or if the industry is not growing, that they're growing their revenue or their margins, which is an important thing to make sure you're not investing in businesses that are going backwards or not sustainable long term. So the other thing I've mentioned is sustainable business. We try not to invest in businesses that we think are going to be a fad, that are not going to be around in a couple of years. And, you know, when I'm talking about that, I guess, you know, a lot of people will be familiar with, you know, one of the greatest fads of the last 10 years, you know, the power balance band. It was something that everyone bought, didn't do anything, that was gone very quickly. So we like to be in businesses we think will be around for a long time, they've got a good long-term product, not something that has got a 2 or 3 year life cycle and then the whole company has to reinvent itself. We also like to invest in companies that are in industries that have got barriers to entry, so not everyone can go and open. So it'd be rare that we'd be going and buying into a coffee shop business, for example, because everyone can go and open a coffee shop. There's very little capital required. There's no regulatory requirement to get a license to open a coffee shop. So we like there to be some level of restriction to new entrants coming into the market. And finally, amongst all of that, we need to see that the business is undervalued. So we need to be thinking that we're, you know, paying 50 cents for a dollar's worth of value. So how we do a lot of that, we spend a huge amount of time out there meeting with the management of companies to really assess what that management's like, what their track record's like. We've got a big process about generating ideas within the business. And so of all of the companies we go and see, so last month we saw 60 companies. We aim to see, you know, between 400 and 500 companies a year, so we're travelling a lot. We've got a lot of companies coming in to visit us. And of the companies we see, most of that's not driven by companies calling us and wanting to see us or other companies doing capital raising. We really try and focus on our own idea generation, so looking through announcements and different things like that, coming up with ideas, doing some research and going and seeing the management. Of the meetings that we have, 63% of those are one-on-one meetings, so we're not attending conferences and seeing, you know, 30 companies in a couple of days. It's mainly driven by our own activities, going out, hitting the road, travelling around, seeing companies, seeing their operations, making sure that we're buying a real tangible business that's there and we've seen the people and, you know, it's not a sham. And it may sound funny, but, you know, I've seen it over the time I've been in the market, businesses that aren't real businesses or, you know, there's fraud involved, and there's a couple of cases of that at the moment. And generally when we're out there, we're seeing the managing director or the CEO of the business. So there's a list of some of the companies. Some of you may or may not have heard some of those things, but, you know, in the last month we saw Synlait Milk, an unlisted company, Stealth Technologies, Metgasco, Southern Cross Electrical, Titomic, Vita Group, Pioneer Credit, and Vera. So there's some of the types of businesses. Most of you probably haven't heard of a lot of those businesses. And then to make sure, on this theme about quality, what we're trying to do is back up our research by not only talking to the managing director and senior management companies, but going out there and, talking to clients of companies, other listed competitors who are in the same space, unlisted companies, salespeople, looking at companies' websites, looking at their competitive websites, because the whole thing about this area of microcaps is very under-researched. There's not a lot of information. A huge amount of it's not covered by brokers. So you really need to make a conscious effort to go out there and get as much information. So continually seeking information on your investments, what's happening in the marketplace, where there's regulatory changes, where the competitors have got new products, and keeping up to speed, because the businesses are so binary. As I said earlier, maybe one product, and if someone launches a competing product that's better, it can be very detrimental to that investment that you've got. So just to really reiterate on and spend a bit of time on management as the first of those key quality items that we look at. Having, we call it superior management, people that have got a track record of success, and quite often people will back themselves. So we call that skin in the game, making sure that it's not other people's money that they're playing with. They put their own wealth into that business. They have shares in the company that they're operating, and they're very driven long-term about making the right strategic decisions for the business that will increase their wealth and simultaneously our wealth as shareholders invested alongside them. So it's a very hard thing to do when you first meet management. Sometimes we'll meet them. Sometimes it takes us 4 or 5 years to make an investment, watching how that company's gone, waiting for the right time to buy the business when the valuation's right, and continually assessing that management's what they say they're going to do and how they actually do that. And there's many management out there that crash and burn or make short-term decisions to benefit their own remuneration if they're remunerated for short-term gains. We like to make sure it's a long-term alignment of interest, and that's where having skin in the game is something that we are very strong about looking at when the companies we invest in. I mentioned growth prospects earlier, but very important to make sure key characteristics of small caps is that you want share price to go up. Generally, that happens when the company starts increasing their revenue or making more profit. The easiest way for that to happen is for them to be growing their market share, taking share off competitors, expanding the market that they're in, or increasing their margins and having that pricing power that they can actually put their prices up. You don't want to be invested in a company where every year their clients are out there saying to them, look, you're going to have to drop your prices. So, for example, companies that supply the automotive industry, every year you hear the term cost downs. Every year they've got to start selling more and more the same product because their margins are decreasing. So we don't think that's a great quality business, and we try to avoid companies like that. I mentioned the power balance band, but sustainable businesses, a company that we can see will be around for 5 or 10 years in the current shape that it's in. So having good products, they've got good positions in their market, not things. We try to avoid fashion businesses. For example, one year, there's been many, many examples. Billabong's had checkered history in terms of launching products, getting fads wrong, as their demographic of people that buy their product changes. Some of the guys in the office, their kids now won't wear Billabong because, the parents were wearing Billabong when they were younger. So you don't want to be in a business that has to keep reinventing itself, or a business where technology, for example, is changing that industry. So we try and be a beneficiary of changes in technology, where we see there'll be a permanent shift in the market. People taking market share away from banks, for example, small financing companies, where we think that's a new paradigm, and there will be shifts in technology that will take market share from older companies that don't reinvent themselves because their business is less sustainable. I mentioned barriers to entry. It's something that we like, so regulated industries. So, for example, one of the businesses in the portfolio that we own is National Vet Care. There are barriers to entry there. You have to be a vet, obviously, to own a veterinary practice. So there's a barrier. So they're the types of barriers to entry that we look for. Telco is another example. You need licenses to be able to sell telecommunications. So they're the types of barriers that we look for. There's varying degrees of barriers in the businesses that we buy, but it's nice when you can have some sort of structural barriers, with the caveat that you don't want your barrier to be government regulation, where you think there might be a change in government regulation and that'll change your business model. And finally, once it's met all those criteria or a combination of those things, we like the business to be undervalued. And there's a range of metrics that we use to try and look at whether a business is undervalued. One of those being a DCF valuation, where we try and project out the cash flows, because what's most important to us is the cash that's coming into the business. And we want to make sure, in the simplest terms, that we think that there's $1 worth of value and we're paying 50 cents for that business. But the DCF is not the only metrics that we use. We'll also use some of the parts valuations, where we'll look at a business, look at the components or the different divisions in a business, value each of those, and say, you know, is that more or less than the current share price? And there's many, many businesses that we keep on a watch list that just aren't trading at the right price. And because we're long-term investors, we can wait 3, 4, 5 years for something to happen and that share all of a sudden to look attractive, and then we'll pick it up, because it's all about where you buy and where you sell. So, you know, when there's weakness in the market, there's short-term noise. If you've got a valuation on a business and you're confident of what's inside the business, it gives you opportunities to acquire those shares at lower levels and make a decent return. So we're going to have questions at the end, but if you are interested, we do a weekly newsletter to our clients, and we do videos in there, so you can subscribe to that on our website. And I'll hand back to Andrew now.
Terrific. Thanks, Michael. Thank you for taking us through that process. I will now hand straight over to Andrew Smith from Perennial, presenting on how to find investment gems in an under-researched microcaps. Thanks, Andrew.
Thank you, and thanks, Hub, for the opportunity to speak today. Microcaps is an area we're very passionate in the market. I've been involved in the small companies product at Perennial for 10 years now. We've always had between 20 and 30 microcaps within our small cap strategy, but last year we made the decision to launch a dedicated microcap fund, and so that's what I'll be talking about today. And the key lesson I want to leave you with is what really attracts us to this market, and that's the under-researched nature of the universe. So why microcaps? As I alluded to, it's an under-researched part of the market. We think it's a very inefficient part of the market, and that leads to strong excess returns. If you look at some surveys from some of our competitors, most managers are doing over 10% excess returns per annum. We're only 1 year old in our fund, but we did over 27% excess returns last year, so off to a good start. And we think the reasons why those excess returns are going to persist in the future is the under-researched nature of the market. What we really like as well is a very diverse universe. Over 2,000 companies we can invest in, and unlike when you look at the top 100, we're not forced to own any banks, not forced to own any resource companies. I think if you take the top 4 or 5 stocks in the ASX 100, you've got 40-odd% of the market. It's complete opposite the microcap end. As I said, 2,000 stocks in that end of the universe. We also have the ability to invest pre-IPO. That's not something I'll talk about today. Just to give you some more numbers around the under-researched nature, this is data from FactSet. So as I mentioned, 2,000 companies in the universe. That's looking outside the top 100 down to right down to nil market cap. On average, if you look at the coverage, there's only 500 of those 2,000 stocks actually covered by any brokers, and that's every broker in Australia that provides the data to FactSet, which is most of them. You compare that with the top 100, there's 12 analysts per stock. So as a fund manager and as an investor, it's very hard to get an edge in the large cap end of the market when there's 12 other highly paid analysts covering that stock. Whereas you look at a micro cap, clearly some of them aren't covered at all, and on average it's only 0.4 analysts per stock. So we've actually seen this data trend to being more under-researched, and Goldman's put out an excellent piece just this month, which I've taken the liberty of taking some charts from. So they talk about the rising information asymmetry in small caps. So this applies to small caps, and I think even more so to micro caps. Exhibit 26 there, if you look at, this is the number of forecasts in the market over time for small cap stocks. And as you can see, we've gone from a peak of about 1,400 estimates out there down to 1,000 recently. And we're seeing the resourcing going into small cap research drop every year. There's been a lot of changes with MiFID and other regulatory changes that I think is going to make this probably get even worse. So the quality of broker coverage continues to fall. Slide Exhibit 28 shows you how fresh this data is. So the bottom line there shows the number of analysts ahead of the company's results. So in the last 100 days, how many analyst numbers have been updated, and that's trended down over the last few years as well. So what this says is for an active manager that's got a big team and can go and do their detailed research, there's mispriced opportunities in the market. The better covered the market is, the less opportunities there is for mispricing. And we really look for mispricing opportunities to make money for our investors. And so I'll run you through some examples that we've found over time and more recently. As I mentioned, it's a very under-researched part of the market, but to research it properly, 2,000 stocks, you need a very big team. I agree with Mike, company meetings are very important, and that's a key part of our process. We did over 1,000 company meetings last year. To do that, we need a very big team, and we're obviously leveraging off our small cap fund as well, given there's a lot of fund in there to help pay for this large team that you see there. Another key attribute of our fund is there's no personal ASX holdings. So if anyone in our team wants to have exposure to the ASX, they have to buy into our funds, and that just avoids any conflict of interest and ensures that all our staff are focused 100% on adding stocks for our investors. Just to elaborate on the process, again, we start with 2,000 stocks. The most important step in the process is really which ones do we reject. We do this a number of ways, the company visit program. Mike mentioned a couple of frauds recently, and we've met with a few of those companies, and you just come away not feeling comfortable. They get rejected and get put in the sin bin, and we won't look at them again until there's a material change in those businesses. So we're kicking out about 1,600 stocks out of that universe on day one. We then go and build up models. We do 10 years of history if we can get it, and 3 years of forward forecast to really build a detailed understanding of what the drivers of these businesses are. We then rank those stocks from best value to least value and build a portfolio between 50 and 60 stocks on that. The other important point from this chart is we run this is not just a set and forget process. We rerun this process every 2 weeks to ensure we've always got the best value portfolio that we can put together in the market. Some examples from our history as a small cap investor. As I said, we've been doing small cap investing for over 10 years and have always had between 20 and 30 micro caps in. A good example would be Melbourne IT. Some investors might remember that from the .com days. It had the monopoly at the time for .com.au registry. Clearly that was a great cash cow business, but it got opened up to competition. The stock faded off everyone's radar, brokers dropped coverage. So at the time we were buying it, which was $1.65 pre a recent capital return, no brokers were covering it. And we saw an excellent cash flow, albeit not much growth in that business, but prospects under new management and some potential changes to really accelerate growth in that business. And if you go and have a look at the initiatives that have been in place since then, they've really supercharged that business, very involved in the mobile and digital economy. Great management teams come in and return that business to growth. So really happy with what's played out there. But we are a value manager at the end of the day. So we actually don't have a current holding in Melbourne IT based on valuation. Still have a very positive view on management though. Index is another example. Quite a bit of detail in this slide, but what I'm trying to show here is just when there's mispricing opportunities, when brokers are either not covering the stock or covering it poorly. So if you look back in early 2016, the brokers were forecasting 1 cent per share of earnings for Index. We've got a resource specialist based in WA, Sam Berridge. He attended the Diggers and Dealers conference in Kalgoorlie and gave me the feedback that exploration spend was starting to recover. There've been 5 or 6 years of underspend. We put increased exploration spend into our model, and we came out with a forecast of 5 cents per share, which at the time was 5-fold versus what the market had. So we built a very large position in our small cap fund and our micro cap fund in Index. You fast forward to now, all the brokers, as you can see, have all gone positive. There's 3 brokers now covering it. The green bar suggests they've all got buys on it, and the consensus earnings have all come up to where our forecast is. And that's really how you make money in the micro cap and small cap end of the market. You identify a mispricing opportunity and you wait until the market re-rates as that news flow catches up. Kogan was another example which came through our company visit program. Clearly with Amazon launching last year, everyone was concerned that Kogan would be one of the main stocks impacted as Amazon launched. We looked at some examples from Canada and the UK, and that suggested the opposite was the case. Some of the existing online players actually flourished once Amazon came in because people became more comfortable with spending online. So we met with management, really impressed with the founder who Mike mentioned having skin in the game. He was the biggest shareholder and still is. And we're really impressed with what he was trying to do with the business. Some new initiatives, for example, they're selling mobile and broadband products on Kogan. and really crunching the data that they get from their website. So we built a very large position in Kogan and have enjoyed a strong re-rating as the earnings have been delivered from what is a great management team. Another thing we find in microcaps is there's some pretty obvious themes in the market, and if you talk to any large cap fund manager, they're probably going to tell you about having exposure to infrastructure. And we all know if you drive around Sydney or Melbourne, even Brisbane where I was last week, the infrastructure boom is here, it's happening, there's money getting spent. But what most brokers are missing is how do you make money for that in a microcap sense? So the two stocks we've identified there are Veris, which I noticed Mike met with last week, and also SRG, which recently raised money. So these are two West Australian businesses that actually have East Coast presence, and most of their money is made on the East Coast. So by their nature, they're actually poorly covered by the Western Australian brokers, and we think that's created a mispriced opportunity where these stocks with great exposure to infrastructure boom have been missed by the market. And you can see the multiples there look very attractive. And finally, to sum up, we're trying to look for, at any time, around 60 of these ideas we want to have in the portfolio at any one time. We want to spread our risk, because you don't always get your timing right, you don't always get your stock calls right, so we want to spread our risk across around 60 stocks. But at all times, our portfolio must be better value than the market. So you can see there, the EV to EBIT of our portfolio is a 27% discount, looking out to FY19, on a price earnings basis of 40% discount. We've also got superior growth in the market, 45% per annum growth over the next 3 years versus the small cap market, which is growing at 15%. And as I said, the trust is only a bit over 1 year old, but a pretty good start, 44% per annum return since inception, and the 1 year number of close to 52%. That's net of all fees. For investors looking for a longer term return series, they can look at our small companies fund. And we also provide some back testing of the micro-cap stocks within that fund if anyone's interested. Both to sum up, just some names of where we're seeing ideas at the moment. Mining services was a trade probably 12 months to 18 months ago that the market had ignored. We've made a lot of money out of this trade. The mining services recovery's happened, the earnings have been delivered, share prices have responded. We still see some value in some select names, but that's becoming a bit more of a popular theme now. We've always been attracted to IT software, good cash flow generally in those businesses, and again, high management ownership in those names that are mentioned there. Agriculture and aquaculture particularly, we think is an interesting part of the market, very capital intensive, but in high demand at the moment. You've seen the salmon price rise. If you walk in the supermarket lately, there's a bit of a shortage in salmon at the moment, so we think Huon's well positioned there. And into Asia, ocean grown abalone, which is actually disappointed since its float, but we think that's a good long-term asset over in WA, selling into the Asian market. And a bunch of other names mentioned there. And worth noting that we've got Sam Berridge, as I mentioned, based in Perth. He manages the energy and resources names for us, and Avanco was one of the stocks he picked last month, and it was taken over by Oz Minerals, so he's adding a lot of value for us there. So that's it, and happy to take questions.
Terrific, thank you, Andrew. Thanks again to both Michael and Andrew for their presentations. We'll just see, we have had a few questions come through while we've been waiting, which is pleasing. So I will continue to talking at the moment. Andrew, will continue the first one to yourself. How do you avoid stocks like Biggin and Get Swift?
Yeah, well, I think avoiding the really big investment mistakes is the first part of our job, and the most important part of our job. So similar to Mike, we do a lot of company visits. We also screen the universe for stocks generating cash flow and stocks that are looking like good value. So to use those examples specifically, Biggin was a company we met with. We didn't really understand why people were paying as much as they were for the videos that they were getting offered. But the cash flows actually look good. In hindsight, we now know why the cash flows look good, and you can just read the AFR to work that out. But what really kicked that out of our process was we had a very unimpressive meeting with management. Just some of the answers to our questions just weren't convincing. A fair bit of it was gut feel. We walked out of that meeting and just threw the presentation in the bin and thought, we'll never look at that stock again. Get Swift was one where the cash flow just wasn't coming through. We track quarterly earnings for a lot of micro caps, and we're looking for a turning point when that cash burn shrinks and companies are becoming cash flow positive, and Get Swift just looked like a long way away from that. So a mix of qualitative and quantitative ways of screening out those two pretty poor investments of recent times.
Terrific, thank you. Michael, one here for you. Why is there less information available from brokers on the microcaps?
Yeah, Andrew covered off on some of those points, but look, it's just not economic for a broker to cover, if you look at the dollar value of companies listed on the exchange, that microcap component, it's 2% of the total market value. So quite often broking firms will either put someone quite junior into covering microcap stocks, and then you've really, sitting in our seat, you've got to assess whether that person's actually got enough experience to give you quality research. And secondly, as sentiment, ebbs and flows in the market, brokers will move in and out of microcaps. So even the coverage that is there quite often is not consistent. Sometimes it's done for corporate objectives for the broker to raise money. Well, sometimes it's very hard. I mean, I put up that slide about companies calling us. A third of the meetings we take are small microcap companies just desperate to get some coverage because they can't get a broker to cover them. So, they're out there doing the investor relations themselves, knocking on the door, trying to generate a bit of interest and tell their story. So that's why there's not that much coverage.
Terrific. Another question that came earlier during your session was, what sort of liquidity issues do you consider when placing a microcap into your portfolio?
Yeah, we look at the liquidity. Sometimes not all the stock goes through the market. When you're a professional investor, you will get, when we're trying to enter or exit a position, we'll call a broker that is familiar with the company. So brokers might have listed the company, they might know who's got stock. Quite often you can't put your stock through the market. So it's a matter of assessing, can you buy it on market or can you get it off market? Are there sellers? Can you talk management? Like, we like management to have skin in the game, but if we want to get set and we think it's a really good opportunity, we'll try very hard to convince them to sell us a bit of stock. So not always does that stock go through the market. That's a very, very key consideration. We've had many investments where you just can't get set. A great investment, you think it's going to go up a lot, but you can't get a meaningful position, so you have to walk away from the opportunity.
There's a couple of questions here that will probably be directed towards both of you, so I might throw this one to you first, Andrew. What role do dividends play in your investment decisions?
At the microcap end of the market, we think dividends are less of a focus. So if you look at our small companies fund, we have to have a better dividend yield than the market on our process. When we set up the microcap fund, we relaxed that, and really that's driven by a pretty basic view that if a microcap is paying out 80 to 90% of their earnings, in 10 years' time they're still going to be a microcap. They just don't have any capital to reinvest for growth. And certainly I was a broker more than 10 years ago. I look back at some of those microcaps then that had 7% yields. They're the same share price 10 years later, paying a 7% yield, and that's just not what we're looking for in microcaps. So we prefer companies to be reinvesting in their businesses and growth options. So we don't focus as much on dividends. I think it's around 2.5% is the average dividend yield at the moment, which is clearly below market.
Michael, do you want to add anything to that from your side?
Yeah, look, we run a couple of different strategies. One of our strategies is a listed investment company. So we seek out franking quite aggressively in that. I'm the second largest shareholder in there. I like the franking. It lowers my tax rate, lowers our self-managed super fund shareholders' tax rates as well. But Andrew did make an interesting point. If a company's paying out too much in dividends, they're really saying to the market, we can't find a better use for the capital. And characteristic of small companies is that you don't really want them to be paying out, staying at a dollar share price, for example, and paying out 7 or 8% yield. You want them to be reinvesting that 7 or 8 cents and getting a 20% internal rate of return on the money they can generate for it. When they've got nothing better to do than pay out the money as a dividend, it really says to you, look, management don't have great confidence in the outlook for the business because they can't think of anything better to do with the capital.
Terrific. Andrew, another one that I think this was touched on but came through during your session was, what is the importance of director trading in their own stocks?
Yeah, we really like to see skin in the game and meaningful ownership by management and the board. But we also look at the signals of director buying and selling, and we have an internal view. If they're not buying, they're lying. So, if a stock's been under pressure and seemingly everything else should be going well for the business, why isn't the board stepping up and buying stock and providing that signal to the market? So that's something we look for. And equally, if we see material selling of stock, talking more than 25% of a founder's personal holding, that's a strong signal to us that maybe the best growth is behind that business, and we should be looking for better investments. As just like management are, they're selling to go do something better with their money. Why aren't we doing the same thing? So that's something we do focus on in small and micro caps.
Terrific. And the last question we've got here before we wrap it up, it seems, is passive funds have gained a lot of interest over the last year, and I'll open this up to both of you. Perhaps you first, Michael, this time. Do you see this investment type as a threat, or do you, the nature of microcap, do you believe active investing is the only way to operate?
I don't think you can run, an index type fund in small microcap companies, and I don't think you can. I don't even think an index fund. There's so many companies out there, and the decisions, as I said before, are so binary. You really need. It's the one area of the market that will always be active. I don't think the index. I don't want to own half of what's in the index, so I can't understand why you buy an index fund in small caps that's owning, 100 or 200 stocks, whatever's in there. I don't know. I don't look at them, but there's so few stocks we find. Andrew's cutting out 1,600 stocks out of the market. And if one of those stocks happens to go into the index, and if it is a Get Swift or a Big Un or a One Page or something like that are rubbish businesses, why would you ever want that in your portfolio? So taking a passive investment in a set of stocks that are just picked because of the size of their market caps, to me seems ludicrous. So I can understand where you've got really good information asymmetry in the top 100, but I just can't see why you do it in small caps. And I also think things can change. Management finds out something, they sell a heap of their stock, and all of a sudden your view on that business has changed. But someone who's not actively looking at the stock's not going to be aware of that, and then you're holding a terrible business in your portfolio. I think you always want to own quality businesses, and I think you have to actively look for them and monitor what's happening.
Great. Andrew, do you want to add anything to that?
Look, I think Mike said it all, but I guess the other angle is passive, and then there's quant money as well, which just chases earnings signals from broker estimates. I don't think that works in small caps either, because as the data I put up, the quality of those signals is getting worse. I think that creates opportunities for people like myself and Mike who do the work, crunch our own numbers, meet management, and creates more mispricing in the market, which I think is an opportunity.
Terrific. That looks like the end of the questions. So we'll wrap things up there. A big thank you for everyone who's dialed in today. Thank you again to our presenters. If you'd like to get in contact with any of the presenters, please get in touch with your HUB24 BDM, and we'll happily put you in touch. Thank you again, everybody.